All right, welcome back to Rockstock Channel. It is Friday, February 2nd, 8:30 in the morning, but 9:30 p.m. Perth time. We have the privilege of having for the first time Trent Barnett, a sell-side analyst at Euroz Hartleys, who just put out a significant note. Lithium prices are too low. We're going to flash this up here. And he was making some arguments on a number of the spodumene producers and their recovery rates and their cash costs versus their all-in sustaining costs. So we're going to get into that in a bit. Euroz Hartleys is Perth-based broker. Trent, you could fill us in a little bit on that, but you cover personally, Pilbara, Winsome Resources, European Metals Holdings. I think you and your colleagues cover MinRes and Patriot and Azure and Wildcat. So a lot of, the interesting, hot, newsworthy hard rock stories in Western Australia, and in Quebec, and then, and again, European Metals Holdings, which is a company hasn't been too much news in there, but we want to, pick your brain about that name as well. Before we start today's video, we'd like to thank Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more later in the video. But first, let's kind of get into your note. But before doing that, why don't you just tell us a little bit about yourself and about, Euroz Hartleys. I met you in 2018 when I was visiting Kidman, Altura, and Pilbara. And I think you or someone else kind of tipped me on MinRes back then. So I've been a happy shareholder in MinRes, since 2018. But I think you were only Hartleys at the time, and Euroz was a separate company. So why don't you just give us your background, the background of Euroz Hartleys, and then let's kind of get into your note.
Yeah, sure. Yeah, that's right. I've been a mining analyst since around 2008, so a bit over 15 years. Covered lithium stocks for a long time. So I think the first lithium stock I ever covered was General Mining. I don't know if you remember that one. That was the Mount Cattlin JV partner back in. Yeah. That's right, Galaxy. That was back in late for 2015, early 2016. So that sort of kicked off the restart of the whole cycle. And then I think the next stock I covered was Pilbara, and that was way back when it was still really an explorer, or still defining and defining the resource back in early 2016. So that, like I said, I joined I was on the Hartley side back then. We did a merger with Euroz in 2020. So now we're one of the biggest. We're a mining specialist sell side broker, really Australian based. I think we're the biggest in Perth. Got a big institutional following and a big retail advisor network. And like I said, we're specialist mining stock analysts.
Okay, great. So, you've been there for, since the early days, and your name keeps coming up in a lot of the capital raises. Canaccord, had owned the space for a long time and still does in a lot of ways. But I've seen Euroz Hartleys show up as joint manager on a number of the capital raises over the past kind of couple of years. We could talk about the financing environment as well as part of this kind of conversation. But let's start. We'll flash up your note here. I think you said, lithium prices are too low. So why don't you just talk through your rationale, in this note, and what does that mean? You did lower your, I think, medium-term lithium price forecasts, but you've maintained your long-term ones. And why don't you highlight what those numbers are in addition to the commentary in your note?
Yep, sure. So I guess being a mining analyst for a very long time, we like to look at the real cash, so the cost that the company is delivering on a total cost basis, and this goes back to the lesson learned, I think, in the iron ore sector back in 2014, 15, 16, when there was an idea of what cash costs were out of the Pilbara, but the reality was the actual costs were substantially higher, and it took a long time for the market to realise that running an industry in the below $50 cash costs was not, iron ore price was not going to be profitable. And ever since then, the iron ore prices averaged around $100 a tonne. And we sort of have this idea because we're very close to the companies, and we have an idea of what the real costs are. We used to do that. Michael Scanterbury, one of our analysts, has been doing that for quite a long time on the gold sector, just doing the actual cash costs there. So now that we've got a reasonable lithium sector, we've done the same thing. So this is not trying to look at what the companies say the costs are. This is the true operating costs out of the company divided by how much production they've made. And when you run that through a lot of the producers in the December quarter, those costs are near 1,000 or well above 1,000. And so that doesn't mean they can't get the costs down, just like the iron ore sector back in 2015, 2016, the costs do come down. It's just how much they have to come down, and whether they can come down. So our idea is at the moment and we're seeing it, I guess, across some of the producers already, they're turning off or they're shrinking production, which is highlighting that the sector isn't particularly profitable. So that's how we think about the margins. They're not quite there to make the sector profitable. So our idea is to make, if those December costs of over $1,000 US a ton are there, then you're going to have to be a profitable industry. We need obviously something higher than that, and then to justify the capital, we're going to need something higher than that as well. So our long run number is around 1625. That to us says the industry can grow, because as you guys know more than anyone, the growth, the current supply coming out of the industry in the December quarter is nowhere near what we need to have next year, the year after, the year after, and the year after that. So we need to repay the capital, not just cover the costs.
So 1625 is still quite low relative to some thought out there that if 2,000 or 2,500 is more likely needed for the incentive price.
That's right. We don't spend enormous amount of time thinking of what is the we're a sell side broker, so we want to put something that is generally accepted as well, rather than what is a true forecast, if that makes sense. So it's to put something in that we think is reasonable and reasonably accepted. I think there's a reasonable answer that the incentive price to really get the sector going again is that $2,000 a tonne number, or perhaps higher. Because we can see at the moment, you touched on the ability to raise capital. I mean, the lithium prices at the moment, the secondary capital market's obviously very difficult. Sort of what price do we need the spodumene price at to justify the returns to put the capital back in? I sort of think that 1,500, 1,600 is the bare minimum. A lot of projects look all right on that measure, but they only look all right. To make them super attractive, to sort of have another flood of capital come back in a rush of supply come back on, you're going to need that $2,000 number to make the returns look sort of exceptional rather than just good enough.
I think your research note shows that like core shouldn't be turned back on unless the price is 2,000.
That's right. We don't cover core, but that's right. I mean, we don't want to get too caught up in what costs could be. We're just looking at what the costs actually were. So on the basis that the companies aren't going to improve costs substantially, that's right. That the price has to be substantially higher for it to turn back on. And management companies, they do all they can to reduce costs, and they have a lot of levers to push. But over a very long time of covering the sector, we like to, we don't necessarily like to say, well, these are what the costs are definitely going to be. But we like to have an idea that whatever companies recently delivered is probably a reasonably good guess of what the future costs are going to be. But that's right, and I think that's maybe something that's a bit interesting for the sector is that there's probably going to be a reasonable amount of supply that can turn back on and get digested as the spodumene price rebounds. So that that 1,500, 1,600, 1,800, 2,000, there is some supply that can come back on. So maybe we have a little bit of a cap for a couple of years as the supply gets digested. What do you think?
I want to put up this chart that you have. You have, core, Sayona, Sigma, which you don't cover either, Pilbara, and then IGO for Greenbushes. You're basically showing, the company reported cost and Euroz Hartleys estimated of total cash cost. So both Core and Sayona were in kind of like ramp up mode. So is it fair to, say that these are going to be their long-term costs? I know that the companies say that, over time, but, Sigma as well as in ramp up, like those three companies are in ramp up, but you're even saying like Pilbara has costs which are higher than, the current price, right? It's above 1,000, but they're reporting, their reported costs are like 500. So what is the difference between, let's say, Pilbara, which looks to be profitable and they're ramping up, they're not slowing down at all. Why is such a big difference?
It's just what the numbers are. So that like for Pilbara, we take the operating cash flow that comes out of that waterfall chart. We add some sustaining capex that they disclose, and we divide it by the production. So it's the actual cash that they spent on operating the company. So it's not just the mine; it's operating the company divided by the production number. So often companies, I don't know exactly how Pilbara determines their own mine operating costs, but we see it across the mining cycle and sector all the time. There's a difference between how the company thinks about costs at the mine site versus how the company or the costs to run the company, if that makes sense. And sometimes they're substantially different. Sometimes it's a timing difference. If particularly if you have if some of the production hasn't quite been turned into a finished product, it might be still in circuit or something. It mightn't get counted exactly right, but that's what it is. Now we have to talk to the companies, I guess, in terms of what is the makeup of those differences. But doing mining sector analysis for over 15 years, it's not surprising that there's a difference between what companies say the costs are and what the true costs to run the company are. We're not suggesting there's a misleading thing there. It's just the way the companies think about mine sites versus the total cost of the company. And I guess as a equity analyst, we're interested in the profitability of the company. If you're pulling levers on the at mine sites in terms of how profitable the mine is, that's often how the companies are thinking about it. Does that make sense? The idea that it's a substantial difference is not uncommon. Like I said, we go back to the iron ore industry when there was an idea that the operating costs were around $50, $50 to $60 for some of the third tier producers. In actual fact, when you did the site analysis at that time as well, the costs were closer to $100. Now those costs ended up coming down, but the industry was very unprofitable. It went through a reasonably short, I guess, cycle of unprofitability and mine closures, and all the analysts were very negative on the iron ore price because they were more interested in the disclosed costs. So in theory, the industry was very profitable back then because disclosed costs said everyone could make a margin, and then as time marched on, that industry has shown time and time again for the last 10 years that in actual fact that you need an average of around $100 a tonne for the iron ore industry to be profitable. So we just think it's the same idea with the lithium sector. The idea of what the costs are for producing mines is a lot different to what the actual costs of producing mines are, and therefore there's going to be a change in there'll be a change in what the idea of long-term spodumene prices are, because it's such a new industry. It's just not developed enough to sort of have a long-term, look at the long-term average of the spodumene price or the chemicals prices. It doesn't really make sense, if that makes sense. There's no floor that it always bounces off. There's no top that it always bounces off. When you think of other commodities, that everyone has a better sense of the range of what the copper is meant to bounce between high and lows and on a continuous uptrend. The iron ore prices like that, the zinc prices like that, lead prices like that, the oil prices like that. The lithium market has no idea, so we're trying to, I sort of think the sell side is where we started back in 2015 we all started on what are the costs of green bushes. Let's take that and make them a little bit worse for the next mines that went into production, and then we're gradually winding up to work out what is the operating cost of a lithium mine in the not a green bushes mine but a lithium mine, the 1.5% to 1% grade LiTO, and we're trying to work out what is that cost. And I think the market sort of got a misunderstanding of what that cost is. We're not negative on the industry. It's just the fact of how the industry operates, and a big part of that, like you said, is on the recovery side. The recoveries, other than a few mines, they continually disappoint.
In your note, the recoveries you were saying are more like 50 to 55%, not the 70 to 75% that the feasibility studies say they're supposed to be.
Yeah, that's right. I mean, we like I've said, we covered Pilbara for a very long time, and Pilbara is an excellent operation. They do extremely well. They know exactly what they're doing, but the recoveries, they're not plus 70, they're sub 70, and that's not necessarily in any way a failure. That's getting out the tons and making and optimizing the profitability of the mine. But that's how Pilbara runs. Some of the ramp ups that we've talked about, which have been a little bit disappointing, the recoveries are substantially lower than that. As you know, there's not a lot of expertise in how to run, how to mine, how to run a spodumene mine. So all operations, when they start in any commodity, are sort of learning how that ore body works, or definitely learning how that ore body works. In lithium, a lot of people are learning how lithium works on top of the ore body. So it's not, in no way is it negative around the sector or the industry or the people in it. It's just the fact that these things disappoint, and that's going to be a disappointment. It's a disappointment on costs, and it'll be a disappointment on supply, and then those two things will work in a circular way to be an even bigger disappointment on supply, and then we're going to get a bigger shortfall earlier than I think people think.
Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LIRC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com.
I'm having a look here, Trent, at your the longer-term pricing. To be honest, I'm struggling a little bit with where I don't know how you can have sort of a spodumene price at $14.25 and then have carbonate and hydroxide at $14.4. How many tons are you assuming go in, and then what's your OPEX or whatever? Is that a break even, or is that your estimate on price?
That's about break even. So
okay. That makes sense.
Yeah, that's right, and that's you guys have a much better understanding of it, and we're trying to be conservative. Like I said, we're sell side analysts. We want our numbers to be too low and get upgraded over time. That's the best outcome as an analyst, and it's the best driver of a share price.
After last year, we'd agree with you, but yeah. So I mean, what would you say? Because again, I think this is going to come up on a China ex-China basis. What is a reasonable operating margin for a converter in China, in your mind?
I mean, I have no superstar insight of it. They've got to repay the capital, so that idea of $3,000 to $5,000 a tonne sounds reasonable to me. But we just don't. I guess that's what the industry is trying to work out. Is that industry going to be profitable, or is it going to be unprofitable? And I guess we go back to that idea of iron ore. The steel industry was very unprofitable for a long time. As that sector grew out, was the iron ore miners were profitable. So I don't, but so I think in the long run number we do like about 8 times to to factor in recovery, and I think I do $3,000 or $4,000 as a margin on top of that to get to that long run number.
And so, I mean, the big issue that we face now is, so we agree with you. I flagged this whole issue of cost at the one-to-one in terms of where reality is versus what you look at, because you've only got to look at the cash flows to know the truth.
Yeah, that's right.
Is how is it then that ultra low grade lepidolite in China is being touted as break even around 11, 12, $13,000 a ton when the grades are extremely low, and they've got to deal with impurities and so on? Is that realistic?
It doesn't appear to be realistic. The cost to mine spodumene and process it, if that's substantially more expensive than lepidolite, that doesn't intuitively make any sense. I don't know what the answer is. We don't travel to lepidolite mines and have a look at it. I just sort of assume that what makes the most sense to me is that China is trying to shore up its own supply chain in the medium term, and part of that is to make sure it has its domestic supply. And I think that's a bit of a problem for the industry at the moment, is that if China isn't buying, then who is buying? And that where is the big demand out of Europe and big demand out of the USA? That those markets are, we're going back to when we started looking at Mount Cattlin all those years ago, where the Chinese market was very, very small. The international market is very, very small, and if the Chinese aren't buying it right now, we're waiting for that international market to grow, which seems a certainty, because unless Europe and the USA are going to let China dominate electric vehicles, they're going to have to integrate a supply chain.
So on that topic, if you look at the Capex costs per ton installed ex-China versus China, the differential is enormous. So, is there a case for some kind of a bifurcation in pricing, or some kind of a rebate into the whole IRA subsidies or others? Because most of the Capex outside of China is at least 30,000 a ton, and in China is sub 10. So how do we get our heads around that?
Well, this is the problem with bifurcated market, isn't it? That some people are going to have to pay more than other people. That's just how it's going to have to happen, and obviously we're not doing the bifurcation of the markets isn't due to economics, it's strategic reasons. So that's the cost we all have to pay for a bifurcation in the economies, I guess. That's just the reality of it. And I think maybe that it's worse than that as well, because the Europeans and US, which are running on an assumption that the mines will bring the supply into on the basis of economics. When you look at the costs and the Capex and everything at the moment, we need very high prices to get it on, even if on a normal planning schedule, which is slow, and that makes equity investors impatient, and they want they want certainty, etc. If the Europeans and US want a rushed supply, which presumably they will at some point, because there won't be enough, then the incentive price has to be substantially higher. We agree, the incentive price has to be, we use 16.25, like I said, because that's a sensible price that most people say that's fine. I mean, if we run all our models at what a long run incentive price is, everyone says, oh, can you just run that again on a more sensible number, or what they consider a more sensible number?
So I guess just in terms of that ex-China and the cost differential incentives, then how does one, do OEMs then need to manufacture and export out of China to compete in rest of world markets? How do they sort of tackle the EV debate there? Because looks like if China overtook Japan as the biggest exporter of cars last year, there was a million EVs. I think this year, looking at the growth projections and targets of the EV companies in China, that number could be 2 for exports this year.
Yep, and that's right. I'm not an auto analyst, but when we look at our end of in that end of the market, you'd say that the Chinese are going to control the EV market and they're going to control the global fleet of cars. So that is the conclusion from where we are right now, unless the rest of the world catches up. And we look at all those slide decks of gigafactories getting built around the world. That's great, but when you look at the slide decks for the chemical processing, the cathode production, that they don't necessarily match up with the gigafactories, I don't think. And I don't, and that to me, that's the next massive wave in the lithium prices when that part of the supply chain outside China gets built and commissioned, and then there's effectively a shortfall of feedstock into that. It'll be just like what happened in China between 2020 and 2024, when there was a big build out of conversion and there wasn't the feedstock. I assume the same thing will happen in the USA and Europe. Otherwise, it'll be the Chinese will control that. They'll control the front end of the which means they control the performance of the car, which means they control where the consumer wants to buy the car, which means they control all the things around cars and autos in the Western world. I mean, how do you think about it? Do you think that's a fair?
Yeah. I mean,
idea?
it's we think it's it's a tough set of facts to look at. It feels like the rest of the world is just going to be split up amongst the Chinese producers. It's going to be very difficult, I think, to compete. On the cathode side, this is, we've raised this, everyone raced to the very downstream of EV manufacture and cells, and then you've got Redwood, hopefully, that gets up for the cathode in the US, and it's going to use some recycled material. But I sort of wonder, Trent, on some level, I understand their jobs and I understand there's repercussions on all these things, but it comes at an enormous price.
What do you mean there? Like
So the cost of competing in all of those levels, and the subsidies and the IRA and all of the factoring in of those, it comes at an enormous price to keep your auto market domestic in the US.
Yep, no, that's right. And Australia's a small country. We spent a long time trying to subsidise an auto industry. It took decades and decades and decades, and in the end, the cost was not worthwhile doing. That was a sort of different geopolitical idea, I guess, and we're a much smaller country, but that's right, the cost of subsidising industries that are competing against a different cost structure is enormous, and the Australian industry was tiny for Australia and obviously globally. But it comes down to that. This is the whole thing, isn't it, really, whether it's of strategic importance to have a non-China car industry or not. I mean, and I don't, like I said, I'm not an auto guy, I'm not a consumer guy, I'm not a defence guy. I don't know whether it is or not. I read some stuff which it is, because electric vehicles will be more, Internet of Things and more connected, and therefore knowing what's in the car and controlling the car is more important. But maybe it isn't. But I don't know the answer. But at the moment, the trends for China to dominate it, because they dominate the chemistry.
In the US and Europe, I mean, the car industries are huge compared to Australia. We can't, we're not going to let that die. The question is, are we going to be, is the rest of the world going to go electric, and and are we going to just have cheap ICE vehicles and big trucks a lot longer? A lot of this is politics. China we're in year 9. In 2015, they had their made in 2025, strategy, of which EVs and batteries was a big component. And here we are, I joked about this. I don't know if I joked on a video, but one of the things I've been saying is GM, built this electric car, I don't know, 20, 30 years ago. And then there was this movie, Who Killed the Electric Car? And who killed the electric car? It might be democracy. In America, when you have Trump, then Biden, Obama, just back and forth, every administration. If you're GM and you're Ford and they're political actors, which way is the wind blowing? And then if you want to have an ex-China supply, we're hearing that the IRA, in theory, was a great thing, we're going to subsidize, but, the number of cars that actually qualify for it, if you're trying to buy ex-China, right, fewer qualify, but buying ex-China means you're paying more.
Yeah.
Because China has everything the cheapest. So, and then the cost of EVs are too expensive in America, right? And China's subsidizing, or the government, organizes, and has efficient, kind of EV charging stations. Like in America, the government, does some EV charging, and then some private companies do the EV charging. I saw a RoMotion presentation earlier this week where they said, like, the government charging stations, 40, 50% of the time are like not working, right? Private ones are working. Like, so in America, government doesn't do things, super efficiently, when they do. But there are incentives for the private sector. There have been incentives, for processing, lithium, but, Jigar Shah hasn't, written a check yet. Permitting is a problem. So like this whole bifurcation is okay, great. But like, China's going to have a competitive advantage because they've had this kind of government coordinated, plan for 10 years. Elon Musk is basically saying, his competitors, the next 9 are Chinese. It's not like the incumbent OEMs. So lithium is very much, was several years ago, a China-focused story, right? In the last few years, it became a diversified US and European story as well. But I feel like it's shifting. Again, we ought to focus on like what's happening in China, right? And it's BYD, it's Geely, it's LI Auto. Their ambitions are great, and they're making cheap cars, and they have cheap lithium at the moment. One thing that this feels like, Rodney and I started this podcast, 5 years ago, and there was this whole idea that like all these like spodumene mines came on stream in 2018, 2019, and there was this oversupply of lithium. And now there's the narrative that there's an oversupply of lithiums coming from, lepidolite, in China or Africa DSO. But we argued back then, in 2018, that there was an under demand a bit, right? Because China changed kind of the subsidy. I'm feeling now that there has been an under demand in 2023, and even right now, following a massive over demand in battery production and cathode production. And I'll flash up here. I saw Robert Friedland tweeted, something, from the FT, which kind of just showed a certain Chinese industry and the growth. And you could see like battery growth, just like it was really hockey stick. And I have another note from Daiwa, which just shows this like percentage increase in battery manufacturing. And a lot of the lithium, there's an oversupply of batteries, and there's a lot of lithium in those batteries. And that's the kind of like destocking that's taken place. So there has been an under demand, as well as, this rats and mice supply from China lepidolite, and the like. We have about 5 to 10 minutes here. Could you talk about, your stock picks, Winsome Resources, European Metals Holdings, Pilbara? And then I also just want to dig a little bit more deeply into that iron ore analogy, because I've made an argument that Pilbara at like 10 or 12 billion market cap, could be the new force in lithium, like FMG was the new force in iron ore. And FMG is now like a 50 billion market cap company. So the trajectory of Pilbara over a 5-year time frame could be still, another 5-bagger from here, in my opinion. I don't know what you think about that, but companies like Winsome, like European Metals Holdings, which are kind of strategic for Europe, potentially for North America, but the stock prices are just like crazy low at the moment. The market's not giving them any credit.
Yeah, I mean, we like Pilbara. It's got obviously got a very strong balance sheet, so it can go for a long time. In a weak lithium price, the management team, like they said on the call, I mean, they've been in bear markets before. They know they don't last forever, and they know that opportunities jump up in bear markets where other companies that are either in development and can't get the capital, or get into trouble because they have debt and can't service it, etc., etc. I mean, or just the exploration ground where people aren't looking over things anymore. So I think Pilbara's well positioned to maybe do some inorganic growth, and that can add some lot of value. What is Pilbara worth? It's worth what spodumene number you want to put into it. Realistically, if you put a big number in, it's worth a lot. If you put in a low number in it, it's not worth as much. But it's within the lithium space, it's definitely a safe stock because they know how to run mines and they have a balance sheet that lets them last as long as this sort of bear market in lithium is going to last. Winsome. I mean, it's maybe it just missed the peak of enthusiasm in terms of the timing of the resource, and maybe that's people may are not aware of how big that deposit is. I guess like we was talking about before, the idea that the market's switching back to to Chinese demand and not as focused on North American demand means that the product's less easy to be sold and developed. So that if you're which is not our view at all. Like we said before, we think the North American has to build out a supply chain. So Winsome is that is a ridiculously low EV for what the deposit looks like. And European metals. I mean, as we know, Europe is not particularly well endowed in
lithium. So EMH is an unconventional project. It's a mica project. It's in Czech. It's very big. It's very well advanced. It's got a good partner.
Market says it'll the market implies that it's not going to get developed, but that really says that again that the Europeans are never going to have meaningful domestic lithium supply, which I don't think that has changed. That they're going to have some way or another some form of domestic supply.
And this is the largest hard rock in Europe. It was labeled strategic, I think, by the European Commission.
Yep.
The Czech Prime Minister, visited. They got a loan from the EBRD. I'm sorry, they got an equity investment from the EBRD. But nothing moves fast in Europe. But when you look at the landscape of Europe, it's partnered with Ches. I mean, look, we're shareholders and advisors to the company, so we're biased here. But our observation is just that news flow is slow, right? Like Europe is, and Volkswagen have slowed down, a bit. They were going to have 6 battery factories. Now they're going to have 3. They're slowing down on the spin out of their IPO of their battery company in the same way that Renault did. But do you hear any rumblings of, any near term, change in Europe or just vis-a-vis this project? I know that their DFS was supposed to be out at the end of last quarter, and now it's, being pushed to sometime this quarter. But any insights further on this name?
Not really. Like you say, it's been slow moving, but if customers need that product, it's going to have to get built. There's not unless people are going to unless the potential users are going to import lithium from elsewhere, which they're going to have to do as well. But if the auto guy that says, well, we're going to develop this project and have some form of domestic supply, is then it's an integrated producer. It has the best potential advantage versus, like we talked about the Chinese before. They won't be reliant on as much logistics. They won't be reliant on a third party. Potentially, it's much more integrated, secure supply chain. So I think it has to happen, but it's that timing, a bit like what we talked about before, that the Europeans and the Americans are well behind on the chemicals and where they're going to get them from. And at some point, it'll flip or crack, and there'll be a mad rush to get these things done. And I think EMH fits into that. So I don't know when it's going to happen, but it'd be very surprising if the implied share price is right and it never happens.
Okay. Just going back to iron ore, you said, I don't know what year it was, maybe 2015, where the market or the analysts were saying, the price was going to be like 50. I think Goldman Sachs, in 2015, some people are making fun that, this is quite similar, their call on lithium versus their wrong call on iron ore back then. So if $50 is, is that equivalent to like the $11,000 call on carbonate prices for, from Goldman? And if they're wrong about that, and, iron ore's average, 100 is the argument that, then carbonate should be 22,000 or twice the number that Goldman's predicting. It seems reasonable, actually.
That's right. But I mean, we have to be fair to Goldman. They called it very well on the way down as well. They're very good at
They've
what
been
they
spot
do.
on.
Yeah.
Don't listen to us. Don't listen to anybody else. Just listen to Goldman, and you would have saved a lot of money.
That's right.
Or if you shorted, made a lot of money.
That's right.
And I make heaps of mistakes as well. It's not all we're saying is that but the logic is right. The market has an idea of what the costs are and what returns are. And if you look at the reported costs of the lithium guys, and you say, well, if they're going to be running, if the industry can run with costs at $500 a ton and it's still $1,000, well, $1,000 is a very good long-term price. But if the costs are more like $1,000, $1,000 is not the right price. So, yep. And as we know in the sell side or markets in general, as trades are going right, people get more and more excited by it, and they start out calling each other on the momentum, I guess. They follow the momentum, and they keep bringing more and more targets that follow that trend, and eventually gets to an overshoot and a silly number, and the logic doesn't make any sense. And I think that we are there with we're there with spodumene. That's right. We're sort of at the $50 number where the industry in iron ore didn't make money. That's the $1,000 a ton spodumene number, and the iron ore price since then's averaged double that. And I think it makes sense that the spodumene price averages double that, because that comes back to that 2,000 number, which most people, when they look at, do I want to put money into our lithium stock or not, they don't put it in unless they're running $1,500 to $2,000 a ton.
Do you think we bottomed, or do you think we can go lower from here?
I don't know the answer, because I'm not a lithium trader. I don't talk to the traders. I don't, in the short term, I just don't know, because I don't have a sense of what that is. And we know that markets overshoot and companies can lose money for, there's no rule that says miners have to make money every day. They can lose money for a period of time. So I can't, I don't know that, but I just think in the long run it makes no, we can't have an industry that's meant to be growing substantially that loses money for a long period of time. And I think if we go back to that iron ore thing, from memory, it was around 18 months, 2 years for the bounce back, and that was an industry that went oversupplied, I guess, because the demand side almost stopped growing. This is an industry which has gone into oversupply because, like you said, there's a small catch up, but the demand side is still growing substantially. So the period of time where the industry can be unprofitable should be quite short.
So when do you think we get back to $2,000 spodumene?
I don't know. I don't want to. It's a hard thing to say.
I know. I just putting you on the spot.
Yeah.
What's your best guess? Is it this year, next year?
Well, I guess that everyone's happy to say that is a sensible idea is the end of the year, end of the calendar year. That's what everyone. I don't know what you think, but everyone. That's a safe thing to say. Oh, I think it's going to happen by the end of the year. That gives everyone a lot of time.
The safe thing to say, Trent, is to say the end of the year. Just don't say which year.
That's right. Yeah, that's right. So I don't know, but it could end up happening way faster, because we are already seeing mines turn off. So people that depending on that production are already going to be short, and then, like I said at the start, we're seeing mines commissioning, and if they don't commission as well as expected, then there's another shortage in there. And meanwhile, the demand side doesn't matter. Even if Europe and US are a bit slower growing, and China goes through a slower than expected growth, the market's still growing substantially. So people are depending on those. People are depending on those near-term lithium molecules, and they're probably not going to come as soon as they thought.
Do you think Sayona turns off North American lithium?
I don't have a strong view. I don't know enough about it.
Do you think Arcadium turns off Mount Catlin?
I don't know. I mean, it's a harder. There's no signs of that, I guess, in Australia, but it's and that goes back to the disappointment, I guess, on costs. That was one of the earlier ones to disappoint on costs, I think, over the last few years. But it's in a very big organisation now, so they can. That doesn't need to be profitable to keep running. They can run that for other reasons, or maybe they can make it profitable.
Well, they'll deplete it and make no money. It's a short mine life, right? Like we think the Arcadium board, the two sides just kind of got together for the first time, at the beginning of this month. I think they're going to look across all their assets and say, why keep it going, for no value if we can, turn it off and turn it back on, some other time, unless there's some other ways to make it more profitable. I think someone told us that there were some times where they blended it with some other ore and they managed to get the cost down and eke out some small profit, but we shall see. Okay. You don't have a full opinion. I'm thinking.
I just think, strategically, there might be a reason to keep running it to keep their customers happy, etc.
Okay, I'm thinking of naming this, the titling, this lithium limbo. How low can you go? I want to ask you, if you were like, what's your favorite, kind of like rock band song? If we were to put this video to summarize Trent Barnett's taste, what song should we use?
That's a harder question. I'll have to think about that.
Okay, we're going to go with lithium. We're going to go with lithium limbo, given your title. The lithium price is too low.
Yeah.
Okay. Thank you very much, Trent Barnett, of Euroz Hartleys. I don't know that you're on Twitter at all, but Euroz Hartleys is on Twitter or X now. So we'll flash up the Euroz Hartleys handle, and they tweeted, this, your note. Really appreciate your coming on, and hope to have you on again sometime soon. And to be continued. Interesting market times.
Definitely. Thank you very much for having me.